Hello everyone, welcome to Option Basic series. So today I'm going to share with you more about delta. So what is delta? So delta is a measurement of the option price move per dollar change in the underlying stock. So for example, 0.3 delta per dollar move in the actual stocks. That means the option price will move by 30 cents. So the range for the call delta can be 0 to 1. And for puts will be on the negative side, will be from 0 to -1 because negative means going down. I want to go downwards movement. I'm betting on the downward movement. For positive will be the opposite, which is the upside movement. So delta also can be like the probability, the chance of it expiration in the money. Like for example, delta 0.3. So in short, we'll be saying that 30%. If I buy delta 0.3, that means to say that there's a 30% chance that this option will expire in the money. Likewise, if you buy 0.1, that means to say there's only 10% of the chance that this option will be in the money. So apart from that, that also shows that the directional exposure. So if you buy a call, that will be a positive delta. If you buy a put, it will be negative delta. So underlying versus delta. So if you buy a stock, that will be of delta 1. So every dollar move, that will reflect directly to your stock price or your profit and loss. So if you buy a call, like for instance, the delta that remains throughout the growth in price, because in actual or option premium, the delta will increase or decrease along with the movement of the price and also time. So let's keep it simple for this instance, whereby delta remains price move and roughly you see from your naked eyes, you can see, how much you are gonna make or how much are you gonna lose, for example. So if you buy a call, 0.5 delta, movement of $1 because of 0.5 delta, the profit will be half. So for example, move $5, 0.5 delta, approximately $2.50. So if you buy a put, you lose, if the price goes up, you lose around 2.5 $2.50. So if you were to sell a call and it move higher, then same as put, roughly $2.50. So if you buy, you sell you sell a call just now. So you sell a put, if you move up, that means you gain roughly 2.5, $2.50. Yeah. So the delta effect, buy versus sell. So if you buy a call, that will be a positive delta. So gain when the stock goes up. Sell call, negative delta. Gain when the stock goes down or flat. Buy put, negative delta. Gain when the stock goes down. Sell put, positive delta. So gain when the stock goes up or flat. So if stock price increase, call delta increase and put delta drop. So if the stock price drop, the call decrease, put increase. And if you buy deep in the money option, it's always near to 1, very, very deep. So when I say deep, that means to say very, very high chance that this price, at this strike price, it will expire in the money. Okay, so it will be very less responsive. So at the money options, approximately will be trading around 0.5, 0.6, or 0.48 or 0.9 delta. So it's pretty sensitive to price change because $1 move up, it can be in the money and suddenly out of the money when it moves down if you buy a call. So we will see a chart if you buy strike at $100, you can see that the delta movement if you buy a call. So you will convert all the way until near 1, delta 1, when the price is 120. So for instance, right, this will be talking about very short dated, maybe 1 day, 2 day DTE or 0 DTE. You can see that it's very, very narrow. This curve is very, very narrow. So if you buy a put, you see that when it cross 100, the chances of it hitting, this is a put, okay? So the chances of it hitting below $100 getting lesser and lesser and lesser and lesser and lesser. This is what they are trying to say. So likewise, if it goes down near 80, you see the chances of it in the money increases. That is layman term. And for a call, likewise, higher chance of it being in the money, lesser of chance be in the money. So delta movement summary. So if you buy a call, 0.5 delta, when the price goes up, the delta increase. And if price goes down, the delta decrease. So when do you buy a call? So when you have a very strong upside, you want more delta, you want to collect more delta along the way, because you want more exposure. Work in your favor. So you buy a put to protect yourself from downside, or you want to hedge or whatever, or you see that the price is going to move downwards. So current delta is 0.5, the price goes up, the delta get lesser. If price go down, the delta increase. So more protection. Sell call. It's a little bit different. If you sell call, when it goes up, the delta goes higher. When you go down, the delta reduce. Very opposite of you buying a call. You see, when the price move down, if you buy a put, if your price moves down, your delta exposure decrease compared to your put. You see, price move down, the delta from 0.6, this one become 0.2 from 0.3. So what you are betting off, neutral or downside? Likewise for sell put, 0.3 delta, when it move higher, the delta reduce compared to you buy a call, the delta increase. So the price goes down, the delta increase. Okay, so the probability of it expire in the money gets higher. That's for example. So what's the outlook if you will do this trade? So you're looking into neutral and more towards upside. Okay, the key interpretation of delta, the probability of it expire in the money, as I mentioned just now. Delta of 0.5 is at the money, so very, very sensitive to price movement. Delta changes with price, time, and volatility, and influenced by gamma. Delta, hedge ratio. So now we learn about delta. So how can delta get involved in your portfolio, for example? So it can be a hedge, or it can be doing something like increase your exposure of the stocks at a cheaper rate, because option is a leverage tool. So let's look at this. Hedge ratio, delta 0.6 call means 60 shares needed to hedge. So if you buy a call of 0.6, that means to say you roughly own 60 shares. Roughly, okay, so this is just a rough example of the 0.6. You hold 60 shares of the price movement. So delta neutral. So what is delta neutral? When you buy a stock, it's one delta, right? So how can I make it flat? That means to say I do not have exposure to the market. So delta neutral is to neutralize to be as good as zero. So when you buy a stock, you have one delta. So to remove this, you'll be buying two contract of puts, right? So yeah, I forgot this minus sign. Yeah. So when you buy put, right, you'll be exposed to negative delta, right? If you buy two of them, will be as good as buying to remove one delta. Then you sell or you can you can sell three contract of 0.33 delta, also make up to one delta. But if you remember just now the underlying component of, sorry, this, which one are more hedged when the price drop? You see, you sell call or you sell put. So this one will increase when the price drop. But this one will decrease when the price drop. So it depends on your vision. You're gonna drop a lot or drop a little. So if you drop a little, just sell call. Or you're gonna drop significant amount. You see that, oh, this is gonna crash. I want to hedge away all the position. Then you know what to do, right? This is a very clear example and illustration. So when you sell a stock, then you get a minus negative 1 delta. So in order for you to hedge it, you have to buy two contracts or call, or you sell three contracts or 0.33 put. So hedging helps you to reduce your delta exposure and also to reduce your overall capital exposure. So when this strategy is too complicated, oh, what is my delta? What's my overall delta? You might be very confused. So the simple way to reduce your risk is to close your stock exposure. Very simple. No need to do a lot of fancy stuff to get yourself hedged. So as a retail trader, you do not need to know much of the hedging. You just need to know how much you are exposed, your capital exposure to the market, and you do not need to calculate to the dot that, oh, I want to hedge this amount of delta away from my stock or away from my portfolio as a retail trader. So delta near or at expiration. So towards the limited time, the delta changes. The delta will become more binary, either 1 or 0. When it left a few minutes, it will become either 1 or 0. At closing, it will be 0 or 1. That's all. There's no in between 0.5 delta, 0.3 delta at expiration, because it already determined and expire. Either you are here or there. That's all. So you can see that from the chart, 60 days delta and 30 days delta, there's a little bit of difference. You see the curve? This is steeper. The steepest one is 3 days or even 1 day. So your range become narrow if the time period is closer. So if your period is 60 days, then you have more room for it to move towards that price or be in the money, be absolute in the money. So the probability is give you chance for it to be possible, like increase the possibility to be in the money. Because at this point of time, we still have some days that you will go back down to negative. So it's not like a sure thing. You buy 60 days, right? Then anything can happen to the market. So if the price moves to 110, the next few days it can drop back to $100, right? And also can drop back even lower. So the delta, the probability of it remains here is maybe is high, but not absolute, right? So summary and strategic use. So to use delta to choose a risk level exposure, higher delta, higher price exposure. Sell low delta option out of the money for high probability and lower risk, so you can collect the premium. Buy medium delta option 0.3 to 0.5 for directional trade. So if you are more advanced, you can buy like whatever, maybe 0.7, depends on your strategy, 0.1, or if you put will be -1, minus 0.1 or minus 0.7, 0.8, whichever. This is for people who are more advanced. They want to sell deep in the money, or buy deep in the money, or sell far away from the money and buy far away from the or sell and buy far away from the money. So delta is to manage hedging and exposure shift. So if you are very bullish, you want to have more exposure. If you are bearish, you want a negative exposure or less exposure. So what's affect delta move gamma? That's very, very direct. And let's take a look at the option premium. So from here, we can see QQQ. For your understanding, we take a look at this. You can see delta here. This is DT1, September 18, 25. And from here, you can see that current trading price is 591.15. 591.15 is around the middle of it. So 0.5 is at around the middle of it. So that's why you can see 512, then this is 0.64. So for example, if you buy a strike of 592 now, and within one day, the price move until it hits 598, for example. You can see that 598 is 0.185 delta, right? So when the price move, the delta follows. The delta follows until here. So what does it mean right now from 0.185 delta? So when the price move higher, the delta will become, as I mentioned, at the money will be 0.5. So from this one is 0.185 becomes 0.5. That's why to say when you buy a call, the delta increase. So when you sell a call, so you have a negative delta, right? Then it become higher negative. To mean to say that most likely you will get called away, like 50% of the chance you will get called away. If you sell this when the price is trading at 591.04, yeah, then this is likely that the delta will move and increase to 0.5. So likewise, you see that for put, maybe you look into 0.3 delta. If I buy here, I buy a strike here, okay? For example, I buy a put, so I get a negative 0.321 delta exposure. That means to say that every dollar move downwards, I will make roughly $32.10. So what does it actually mean? So when the price move higher, when the price move lower, my delta, my negative delta get bigger. So from when the price move from 591, move all the way to 587, from 0.321 delta, negative 0.321 delta, my delta will become near minus 0.5. So that means to say my delta get larger and larger when you buy a put. So when you sell a put, it become a positive delta, right? So 0.321 become negative, right? Become positive because it's sell. So if I sell a put here, when the price move down, my delta increases. That means to say likely this will be in the money and I will get a sign. Right? So if it move away, let me say my delta get lesser and lesser, right? Lesser and lesser. So my chance of getting a sign is lower. Yeah. Pretty clear cut. So any question you can ask me in the comment section. I'll try my best to reply everyone. And if anything that it doesn't make sense to me, please let me know so that I can work on it on the next video. So thank you for watching. Please like, share, subscribe, and comment your question below. Thank you very much and have a nice day. Be safe.